If your Canadian subsidiary is paying management fees, royalties, shared services back to its U.S. parent or U.S. affiliate, you are already on CRA's radar. In 2026, they are not just reviewing these transactions, they are actively scrutinizing them. And with their technology, it's very easy for them to do this. So if you think you can throw a percentage on a management fee or move money across the border without documentation, think again. You're setting yourself up for reassessment by CRA, and those reassessments don't come cheap. So in this video, I'm going to walk you through how CRA actually looks at your cross-border payments, what commercially reasonable really means, and what documentation you must have in place to avoid recharacterization of intercompany charges by CRA. And these recharacterizations lead to penalties and double taxation. So let's get into it. Hey, I'm Duncan McPherson, and I'm a dual qualified CPA in both Canada and the United States. And I help companies like yours deal with cross-border transactions so that they hold up scrutiny to both the IRS and the CRA. And this scrutiny, it's not just on paper, it's in practice too. And cross-border intercompany charges is one of the biggest problems that I see. Because on the US side, often there's less scrutiny. In Canada, not so much. CRA takes a much more aggressive stance on anything that looks like money leaving the country. So let's start here. When CRA sees payments leaving your Canadian company to its US parent or its US affiliate, they ask one simple question. Would an independent third party pay this amount under these circumstances and under these terms? Now that's the standard. Not what's convenient, not what makes sense internally, not what your US accountant signed off on, but what would a third party do? And if CRA decides the answer is no, they have the power to deny the deduction and recharacterize the deduction. The recharacterization can lead to withholding taxes, and that can lead to late payment penalties and late interest penalties. And this is where things get expensive and get expensive quickly. Now let's talk about management fees. This is where I see the most problems. It is also where the most danger lay for your business. Say your company looks at its head office costs, picks a percentage, and allocates these costs to Canada. No breakdown, no support, no real connection to services provided. CRA will thank you for this, because that does not work in Canada. For a cross-border management fee to hold up, it must be clearly tied to actual services performed. Itemized clearly on an invoice, not just on your financial statements. Priced at fair market value and backed by a contract that requires payment. If you don't have all this, CRA can recharacterize the entire amount, and they will. And now you've got no deduction in Canada, taxable income in the United States, and potentially withholding tax layered on top of that. Your unsubstantiated management fees are subject to 25% withholding tax in Canada, plus penalties and interest. But you'll be happy to know that that's your worst case scenario. So now let's move on to royalties. If you, the US parent, has intellectual property that your Canadian subsidiary is paying to use, that's fine. But again, the same standard applies. CRA wants to see how your IP is being used, how it contributes to revenues, and how you determine the royalty rate. And this is where benchmarking comes in. You need to show that your royalty rate aligns with what similar companies would pay to third parties. And if you can't support that, CRA can reduce the amount of the royalty deduction or deny it completely. And if you've done something to really piss them off, they could reclassify it as a management fee. But that is very unlikely unless they're angry with you for something else. Now let's talk shared services for a moment. Things like software licenses, IT, HR, legal support. These are legitimate chargebacks to your Canadian subsidiary. But again, they need structure. What CRA is looking for here is a clear allocation method, consistency across periods, and documentation showing how the costs were calculated. And if you're allocating these costs based on a rough estimate, they're going to get challenged. Okay, so let's move on. Here's a term that gets thrown around a lot, commercially reasonable. Well, what does it actually mean? If you strip away the relationship between the two companies, would the transaction still make sense? Would an unrelated company pay that amount for those services under these terms? If the answer is no, you've got a problem. So what should you actually have in place? Well, properly executed and signed intercompany agreement outlining the intercompany charges. That's number one. Number two, detailed invoices outlining services or usage. Number three, transfer pricing support or benchmarking analysis. Number four, a clear methodology and how these fees were calculated. And number five, Records that tie everything back to your financial statements, not just the agreements themselves, or not just the agreements to the financial statements. The agreements, the financial statements, and the actual payments all have to gel. It's what we call a complete circle of documentation. And if CRA sees you have all this stuff, they tend to move on to low-hanging fruit. And when they don't see it, that's when audits escalate. Let me say this clearly. This is not an area to clean up later. You must do it real time as you go. Once CRA reviews these transactions, you don't get to go back and rebuild the story. You're committed. And either you have the support or you don't. And if you don't, you're negotiating from a very weak position. So if your Canadian company is paying its U.S. parent or its U.S. affiliate management fees, royalties, or shared services, and you're not completely confident that your documentation would not hold up under an audit, go to the MacTax.com right now and book a no-cost, cross-border tax strategy call with me. I'll walk you through your current structure, your intercompany flows, and what needs to be tightened up before CRA takes a look. Don't you ever forget that good documentation is a repellent as well as a solution. Here's your takeaway. Cross-border payments is one of the first places that CRA looks. It's easy for their algorithm to attack it. And in 2026, the scrutiny is only increasing. Remember, 80% of tax problems are from sloppy bookkeeping and late filing. So make sure your transactions are real, your pricing is defensible, and your documentation tells a complete story. I'm Duncan McPherson. Stay sharp, stay compliant, stay out of tax trouble, and I'll see you on the next video. Take care.